think what's interesting too is a lot of folks believe, valuation or value buying based on intrinsic value requires a catalyst in order to realize it. And we would say that's not the case at all. The human behavior is the catalyst that's constantly over and undershooting. In the context of an asset pricing model, what we found is regardless of how you want to handicap intrinsic value, whether it's a CAPM, a FAMA French 3, a FAMA French 5, you incorporate momentum into it, which is what AQR did. Regardless of how you're handicapping the results of valuation, the alpha is always significant. Interestingly, when you take, let me just pop back to a slide earlier, just kind of run that really quickly, just to show you some idea of magnitude of that. Oh, maybe it was the other way. I was probably right near it the other way. Apologies. When you look at it from the perspective of how do other factors look, from the perspective of do they generate alpha in the presence of valuation, the answer is kind of interesting. So this is the alpha to basically the intrinsic value factor, which is our estimate of intrinsic value divided by the stock share price ranked. So to the extent that that ratio is high, the stock is undervalued. If it's less than 1, the stock is overvalued, and you form an intrinsic value factor with kind of the 30, 40, 30 sortings of portfolios. And what you see is regardless of which model, not only is the alpha there, but statistically, the p-values and the t-stats to this alpha super strong. Right. Now, you take the same concepts of what are traditional asset pricing variables, and we did this during COVID because we couldn't talk to anybody. So we thought, okay, let's figure out how we have our coming out party. So we constructed an applied finance asset pricing model that has intrinsic value, corporate performance, and instead of book to price, to us, book to price is sort of a noisy proxy for leverage. So we put leverage in directly, and then obviously we had size also. And when you do that, all of the factors that tend to get attention from an asset pricing perspective, they're all insignificant. Some of them, momentum generates alpha, but the t-stat on it's only about 1.2. So it's a very noisy estimate of alpha after you've accounted for what's the company's performance and is the company over or undervalued, and then what's its leverage. There's just not a lot of meat left on that bone.
The alpha from the momentum factor probably comes from
momentum factor for all of these factors. The profitability factor goes away. The investment factor goes away. The low volatility factor goes away. Beta goes away.